Hello everyone, and welcome back to Explain the Charts. Today is November 24th, 2025, and we're taking an in-depth look at the S&P 500 ETF, ticker symbol SPY. The market is currently in a fascinating tug-of-war between bullish and bearish narratives. On one hand, there's a surge of optimism fueled by renewed hopes of a Federal Reserve interest rate cut as soon as December. Comments from Fed President John Williams suggesting that labor market weakness is now a greater threat than inflation have significantly boosted the odds of a cut. This has caused a sharp reversal from the recent pessimism that the Fed might hold rates higher for longer. On the other hand, the market is grappling with persistent fears of an AI bubble. Tech giants, especially Nvidia, have been under intense scrutiny. Despite Nvidia reporting stellar earnings and showing incredible growth in their data center revenue, some high-profile investors like Michael Burry are reportedly betting against the sector. We've seen this tension manifest as sharp, volatile swings in the market, with an AI-led sell-off being quickly countered by a rate-cut hope rally. So, let's turn to the charts to see how this story is being told in the price action. Starting with the daily chart, we can see the broader picture of SPY's performance over the past year and a half. After a significant correction in early April 2025, where the price dropped from around 560 down to a low near 481, the market staged a powerful recovery. This rally pushed SPY to new all-time highs, peaking around the 688 level in late October. That 481 level now stands as a major long-term support area should we see a severe market downturn. More recently, the price has been consolidating after hitting that all-time high. The volatility we discussed in the news is clearly visible in the last few candles. Notice the large red candle on November 20th, where SPY dropped over 3% from a high of 672 down to a close of 652. This move happened on significantly higher volume, suggesting strong conviction from the sellers, likely driven by those AI bubble fears. The following day, November 21st, saw a recovery rally back to 659, which aligns perfectly with the news of renewed rate cut optimism. However, it's worth noting that this bounce occurred on lower volume than the preceding sell-off. This could imply that the bullish conviction is not yet as strong as the bearish pressure from the day before. The key battleground is clearly defined by this recent price action. The immediate long-term resistance is the all-time high around 688. On the support side, the recent low of 651 is the first critical level to watch. Below that, we might look for support in the 640 to 645 range, where the market consolidated in early September. Let's zoom in on this recent activity over the last couple of months. Here on the daily chart from October onwards, you can see the final leg of the rally to the 688 peak. Since then, November has been characterized by choppy, sideways action, largely contained between 660 and the highs. The sharp break on November 20th was the first decisive move below that consolidation range. This indicates a potential shift in market structure from bullish to neutral or even bearish. The subsequent bounce on the 21st is critical. It brings the price right back into this contested zone. We are now at a crucial inflection point to see if the bounce has legs or if it's just a temporary relief rally before another move down. Switching over to the 1-hour chart gives us a more detailed perspective on the short-term trend. From this viewpoint, we can trace a pattern of lower highs and lower lows throughout much of November, a classic sign of a short-term downtrend. The plunge on November 20th is even more dramatic here, slicing through multiple support levels, including the key 662 area. The bounce on the 21st was strong initially, but appears to have stalled right around the 664 level, which was a previous support area. It is very common for a former support level to turn into resistance. Therefore, the 662 to 664 zone is now a critical short-term pivot. For the bulls to regain control, they need to decisively reclaim and hold above this area. Failure to do so could see sellers step back in, pushing the price back down to test the recent lows. Finally, let's drill down to the 15-minute chart to analyze the intraday price action from last week. You can see the enormous volume spikes during the sell-off on November 20th, indicating periods of panic and capitulation. The recovery on Friday the 21st began with a strong gap up, but then spent most of the day consolidating in a range. This suggests some uncertainty and a balance between buyers and sellers following the recent volatility. For active traders, the immediate levels are clear. The upper boundary of the recent consolidation near 664 is the key resistance to break. The lower boundary and recent low around 651 is the key support. A move outside of this range will likely dictate the market's direction for the next few sessions. So, to recap the entire picture, let's return to the daily chart. The market is at a crossroads, influenced heavily by macroeconomic news from the Fed and sentiment around the tech sector. Your key resistance levels to watch are, in the short term, 664, followed by 667 and 672. The ultimate resistance remains the all-time high around 688. On the downside, the 660 level is the first line of defense for the bulls. Below that, the critical support levels are the recent low at 651, and then the more significant zone around 640. Now for our unbiased predictions. We see a slightly higher probability for a bullish scenario, perhaps a 60% likelihood. If the positive sentiment regarding a December rate cut continues to build, and we get no negative catalysts from the tech sector, SPY could break above 664 and make a push towards the 672 area. This scenario would be reinforced if we see buying volume increase on the up moves. Conversely, the bearish scenario has about a 40% likelihood. If conflicting news from other Fed officials emerges, or if there's another tech-led sell-off, a failure to hold the 658 to 660 zone could lead to a retest of the 651 low. A confirmed break below 651 on high volume would signal a deeper correction, likely targeting the 640 support level. Things to watch for this week will be any further speeches from Fed members and upcoming consumer data, especially related to Black Friday sales, which could heavily influence the Fed's next move. Stay vigilant and watch these levels closely. And that concludes our analysis for today. Please remember, this video is for informational and educational purposes only and should not be considered financial advice. Trading involves risk, and you should always conduct your own research and due diligence before making any investment decisions. If you found this breakdown helpful, please hit the like button, subscribe to Explain the Charts, and ring the bell so you don't miss our future updates. Thanks for watching, and we'll see you in the next video.